Welcome to the EQUIS Institute. Today we are going to talk about a journey. This journey is going to bring us from the so-called lazy beta to the smart beta, which is a much more comfortable situation. So let me try and explain what we mean by beta, what we mean by lazy, and what we mean by smart. Okay, let's start with what we mean by beta. Well, beta is a quantitative measure of exposure of a portfolio with respect to a rewarded risk factor. This is an important statement. When we invest in stocks, we are not so much excited about investing in stocks in terms of the performance that the stock, that the holding the stock is going to bring for us, because of what makes the stock specific. What's more interesting is actually the systematic risk exposure. Portfolio theory actually suggests that the premium that you earn from holding a stock comes from the stock exposure to these rewarded risk factors. And the remaining risk, which we call specific risk, what's specific to the stock, is actually uncompensated for. And the reason why you're not being rewarded for holding specific risk, well, it's precisely because unless you're lazy, and we're going to come back to the lazy aspect of investment, unless you're lazy, you can easily diversify away specific risk. So there's no reason why you should be rewarded for something that you can diversify away. What are these rewarded factors in equity markets? Well, the first factor is the market factor itself. So if you go long equity markets, there's an equity risk premium that you're going to earn for holding the market as a whole. Now, risk exposure in equity markets, just like in fixed income markets, by the way, are not unidimensional. They are multidimensional. There are multiple rewarded sources of risk in addition to the market factor. The first one is the value factor. So it's well known ever since the seminal work by Fama and French in the 90s, in the early 90s, that value stocks tend to outperform growth stocks. And by value stocks, we mean stocks that tend to be relatively inexpensive in terms of book value with respect to market value, while growth stocks are more expensive. And the bottom line is holding value stocks generates a premium over the long run. Value stocks outperform growth stocks. The size factor. Turns out that, again, seminal papers by Fama and French, that small cap stocks tend to outperform large cap stocks. So there's a premium for holding a smaller cap stocks. There's also a momentum factor that has been put forward by Carhart in a 1997 paper and another related work before him. Winners tends to outperform losers. So if you look at the past performance of these stocks and you select the winners, well, holding on the winners tend to be better than holding on the loser stocks. Now, you may think about whether we can explain and understand these sources of outperformance. And in some cases, we can, because there's rational explanations for why value stocks and small cap stocks, for example, have a higher performance. And the reason is they are probably more risky. And if they are more risky, then investors expect a higher premium for holding these more risky stocks. Sometimes it could be some behavioral pattern that is consistently repeating over the years. It could be other explanations, but these are the three most commonly analyzed factors in the equity space. There are other factors as well. The low vol factor. It turns out, at least historically, that low vol stocks do outperform high vol stocks, which is a little harder to understand because if anything, you would have expected the opposite relationship. High vol stocks being more risky, they should have outperformed low vol stocks. Well, that's not exactly what we find. And there's a long debate which I'm not going to enter into, just don't have time for that. Try and understanding, explaining away the low vol factor, or as we call it, the low vol anomaly, because that's what it is. It's an anomaly. There's also a liquidity factor, so we have reasons to believe that illiquid stocks outperform liquid stocks, which then, in this case, is perfectly meaningful. There's a premium associated for you. If someone wants to convince you to hold an illiquid stocks, then you should be rewarded for that. There's also so-called quality factor. Quality stocks tend to outperform junk stocks, and I'm not going to get into the details on how we measure quality. But anyway, so here is the first statement. The first statement is individual stocks earn a premium from these risk exposures. Now, the next question is, how do we go about harvesting this risk premia? If, as an investor, I'm keenly interested in harvesting this risk premia, what's the best way to go? Well, the default option would be to use a cap-weighted benchmark, which is like a cap-weighted index as a benchmark for either active money management, benchmark for managers who are trying to outperform the benchmark, or the cap-weighted index as a benchmark for managers who are trying to replicate the benchmark. Now, in the previous video, we have provided empirical evidence that cap-weighted benchmarks were not a very good starting point. That cap-weighted benchmark actually underperform very simple benchmarks like an equally weighted benchmark. So we have to try and understand what's wrong with these cap-weighted benchmarks. Well, there are actually two shortcomings and not one. Shortcoming number one, cap-weighted benchmarks provide a poor diversification of unrewarded specific risks. In other words, due to the strong concentration in the largest cap stocks, these portfolios end up not being well balanced. They are very concentrated. And this implies an excess of unrewarded risk in your portfolio. Well, a classic example was Finland. Years ago when Nokia was doing well, and Nokia was more than 50% of the Finnish stock market at some point. So anyone holding the Finnish stock market, hoping that it would be well diversified, were actually essentially holding Nokia plus 50% of more companies, and half of these 50% were companies doing business with Nokia. So in the end, when Nokia ended up on the losing end of the emergence of the smartphone technology, well, all of these so-called diversified investors actually who were not diversified lost a lot of money. So that's the problem with cap-weighted indices. They tend to overweight a few stocks, which are the most expensive, by the way. There's another shortcoming, which is cap-weighted indices, above and beyond the fact that they tend to overweight some stocks, they might actually end up overweighting the wrong stocks. So what I mean by that is the cap weighting scheme by construction will imply a large cap bias and a growth bias in your portfolio. Now, this is not exactly good news because we've just talked about empirical evidence that says that small cap stocks tend to outperform large cap stocks and value stocks tend to outperform growth stocks. So if anything, if you want to harvest risk premia as opposed to pay risk premia, you should have a long bias towards small cap and not large cap, and value and not growth. But that's not what you're going to get by default with these cap-weighted indices. Now, we can't even blame cap-weighted indices for not being, efficient portfolios and not giving you the best risk-adjusted performance. After all, cap-weighted indices have never been engineered to generate outperformance. The blame should be on us, investors or asset managers, if we are to use them as benchmarks. That's a convenient option, but that's the lazy way. We should work a little harder and construct better benchmarks that are more efficient at harvesting risk premia. This is what we call smart beta benchmarks. Now, smart beta is not a great name. That's a marketing name that this industry is now using to talk about attempts at harvesting risk premia in a more efficient way than a lazy cap-weighted index. So we call them smart, just mean better diversified, more efficient at harvesting risk exposure, if you will. Now, historically, smart beta products, the first generation of these smart beta products, have mostly focused on the first shortcoming, which is they have recognized that cap-weighted indices were too concentrated, and they have tried to use other weighting schemes so as to avoid this excess of concentration. In the previous video, we talked about the equally weighted scheme, and we said and we showed that equally weighted portfolios tend to outperform cap-weighted portfolios on a risk-adjusted basis. And this is simply because they are more balanced. There's also GMV. GMV stands for Global Minimum Variance portfolios, like low-risk portfolios constructed on the same stock universe. They tend to also outperform cap-weighted portfolio. ERC, Equal Risk Contribution portfolio, also known as risk parity portfolios, like naive diversification, but applied to risk contribution as opposed to dollar contributions. Other people have looked at very heuristic fundamental measures of size for weighting stocks, for weighting companies within an index, and deviating from using market cap, but using sales, dividends, turnover, any kind of measure of the company, fundamental measure of company size. And all of these alternatives actually were shown or were found to outperform cap-weighted indices, which probably suggests that cap-weighted indices were indeed a pretty wrong starting point. Now, the problem is all of these so-called smart indices, like an equally weighted index or minimum variance index, they also suffer from their own factor biases. The problem is by choosing a weighting scheme like equally weighted, minimum variance, risk parity, fundamental weighting, you're not paying attention to the kind of risk exposure that you're building up within your portfolio. So you might be doing a better job at solving problem number one, which is a poor diversification of unrewarded risks within the cap-weighted benchmark. But you're not necessarily doing better in terms of getting a more accurate exposure to rewarded risk premia. Well, this recognition has given rise to a second generation of so-called smart beta products, which we call now smart factor indices. So in other words, the idea is you're selecting a given risk exposure. Say you like the value stocks. Well, then you select only value stocks. Or you like low-vol stocks, then you select only low-vol stocks. Or you want to bet on momentum, so you select the past winners. So that's step number one, selection of these factor-tilted stocks. And then you're using a smart weighting scheme to diversify away as much as possible of unrewarded risk in your portfolio. So in other words, pointing in the direction of value or in the direction of growth or in the direction of low vol is getting some factor exposure. But then you want to make sure that you're holding the best rewarded factor exposure along the dimension to which you're pointing. Well, Eugene Fama, who's another Nobel Prize winning economist, financial economist, has a very simple statement that explains and that says it all. He says, well, after all, finance is pretty simple. What we see in finance is just hold diversified portfolios along whatever tilt that you choose. And that's exactly what a smart factor index is all about. Okay, so let's take a look at the performance of these two generations of smart products. Smart Beta 1.0, in this case, the focus was on weighting schemes. So we're looking here at 4 different weighting schemes in the US and in the world large cap stocks. And what we find is in all cases, the first line here shows the excess annual performance with respect to the corresponding cap-weighted index. And the annual outperformance ranges anywhere between 1 or more than 1 all the way to 5% annually. And we get this with an even lower volatility with these smarter weighting schemes. And the conclusion is, of course, you get a much better Sharpe ratio. So this says that, cap-weighted as a weighting scheme is not the best weighting scheme. It's too concentrated. You can do better. Well, the next step, and that's what we call Smart Beta 2.0, is you're going to implement the same approach, but you're going to do it on sub-universes which have been selected as a function of a given criteria. These are the smaller stocks in your universe. In this case, these would be mid-cap stocks. These are the past winners. These are the lowest vol stocks, 50% overall stocks, and this is the 50% most value stocks. And what you find is the following. First of all, if you look at the Sharpe ratio of the S&P 500 index cap-weighted, it's 0.4 with an expected performance, average performance of 12.16% and annual volatility of 17%. Now, if you hold a cap-weighted, still cap-weighted portfolio of the factor-tilted stocks, you get a better Sharpe ratio. Better for size, better for momentum, better for low vol, and better for value. Well, this is just a translation of the fact that these factor exposure have been rewarded, at least historically. And the next step is, as opposed to holding a cap-weighted portfolio of this factor exposure, you're now going to hold a smart-weighted portfolio of this factor exposure. If you hold a smart-weighted portfolio of this factor exposure, in all cases, you get a further improvement in terms of Sharpe ratio. Okay, so the conclusion is simple. Select the factor tilt that you like and hold a well-diversified portfolio along that factor tilt, just like Eugene Fama just said. Well, smart beta, whether it's 1.0 or second generation 2.0, smart beta is actually on the rise. Assets invested in smart beta equity ETF have reached more than $500 billion at the end of June 2017, which was a plus 15% increase. The strategies are now 20% of all assets invested in ETF. So what it seems is, and there's an article from the Financial Times and The Economist talking about the impressive rise of smart beta. So the conclusion is an increasing number of investors that go the passive route, in other words, that want to replicate a benchmark, have come to the conclusion that the cap-weighted benchmark was not the best starting point and that they should use a smart-weighted benchmark. Let me end with a few words about smart beta at the EDHEC Business School. It turns out that we've been very active within EDHEC Risk Institute and beyond on the smart beta space. We've done lots of work on smart beta and the problems with cap-weighted indices and the way to fix those problems. And most recently, in April 2013, we've launched a new venture, which is called Aries Scientific Beta. And this new venture is essentially a smart index provider. So yes, what my colleagues at Sci Beta are doing is they are providing the world with more efficient benchmark, helping asset owners and also asset managers more efficiently harvest risk premia in equity markets. Outperformance have been pretty consistent so far, 100%. Well, in the past few years, looking at all 3-year period of time, we've looked at what was the proportion of these 3-year periods of time in which the flagship smart-weighted benchmark from Scientific Beta has been able to outperform the corresponding cap-weighted index, and at least historically, it turns out to be 100%. Of course, it doesn't mean that it will always outperform. There are market conditions under which we expect smart beta to underperform cap-weighted, but what we know is across many market conditions, and therefore across long time periods, smart beta will provide a much more efficient way of harvesting risk premia. There are currently more than $16 billion managed under Sci Beta indices, and this is one of the contributions from EDHEC Business School to a better understanding of risk premia in equity markets and how to harvest them.